Bitcoin is absolutely getting hammered because we've said, and if you aren't aware, it really is a risk asset. We started saying that this would be a volatile year, albeit we thought it would be a good year. There's not enough infrastructure in place to really keep up with the demand for the power that these data centers will take, because there will be times just like this when you get bit if you chase price of particular companies.
A lot of times people will get in a situation or a scenario where you're catching a falling knife and it goes down and down.
Hello and welcome to the Wise Money Guys radio show. I'm your co-host John Scambray, and I am here with my partner this weekend,
Giuseppe Visconti.
And we are certified portfolio managers, which means we're investment experts. And we love helping people who are about to retire or are retired manage their money. As always, if you want to get a hold of us for questions or schedule a no obligation consultation, or better yet, register for our March 4th seminar at Wood Creek Golf Club from 5:30 to 7, again on March 4th, which is a Wednesday, give us a call at 916-967-3500, and we'll mention that again later in the show and what you can expect to get out of that. Food will be great. Information will be great, but learn more about that later on in the show. First of all, if you haven't tuned into us before, Giuseppe and I have been doing this for a while, you could say, almost 50 years combined, me in the, over 30 plus years, Giuseppe, over 16 plus years.
Almost 20 now.
Almost 20. My goodness. And we're still spring chickens. That's what's great. But honestly, experience, especially in times like right now, matter, because we've been hopefully educating the public, talking as much as we can, putting out, advice and ideas. Well, not advice, but suggestions and ideas that exactly what is happening right now would be happening. We started saying that this would be a volatile year, albeit we thought it would be a good year. Still think that, right?
Yeah, not without speed bumps, which
but
we're
not without speed bumps. That's a great way to put it. I talked a lot about headwinds and tailwinds and speed bumps, and I said repeatedly, look for these things to affect the profitability in your positions and, rebalance. Don't be afraid to buy dips. Don't be afraid to lock in, some gains. And hopefully, if you're not giving us a call, if you're not a client already, you've been paying attention and doing some of those things. And so
you can also, by the way, find out more information about us on our website, which you can go to wisemoneyguys.com, which currently is being revamped. So hopefully pretty soon we'll have a new fresh website.
Yeah, it's been a while. I think that thing I've been having it tweaked and tweaking it myself since I think 2015. So it's kind of stale.
Yeah. So we'll have a new one, but for the meantime, you can find out more about us. There's some interesting tools in there, retirement and calculators. And then you can scroll down.
There's videos, there's educational videos on, how to dollar cost average, how to do basic trades. There's a video and a tutorial just about on every topic with respect to financial services, including things like, how much debt you should have. Should you, what would a mortgage cost you? As you said, calculators, but there's newsletters. And of course, there's ways to just get a hold of us from there as well. And also there's our disclosures, which we have to put up there, which just tell you a little bit more about our company, which are at the bottom of the page. By the way, the Wise Money Guys show is brought to you by One Source Wealth Management. That's our official SEC registered investment advisory firm, which is licensed 319078. And keep in mind that there is no investment that can't lose value. And I don't know how you got me on this, but and past performance isn't a guarantee of future results. I mean,
well, I think the website kicked that off.
That's what did hit.
But we have quite a bit, I think we will digest a little bit of what's going on with the volatility that we've been witnessing. recently, going to a little bit of earnings. A lot of volatility in the Mag 7 and some of the AI.
It's really the software
and
side
cryptocurrency
of tech that has just been getting hammered so far this month.
Right.
Bitcoin is absolutely getting hammered because we've said, and if you aren't aware, it really is a risk asset. It is not a reserve currency. It is not a stable investment. It is a risk asset. And one of the first things people sell when there's volatility is their highest risk assets. And guess what? Bitcoin is one of the highest risk assets out there because it's backed by nothing. It is nothing. So it always cracks me up when people, or we read or hear or watch on, some of the services that we watch.
Street?
Yeah. I mean, honest to God. And you get the people on there, the sailors of the world, sailors. Yeah. That, no matter what, put all your money in it. And my goodness,
he's put a lot of his company assets in.
Well, it's great if you made billions, because now you're only giving up some profit in the millions, but you're still in the billions.
Yeah.
And so, but people, buying it now, I don't think it's at the bottom yet. And as far as advice, which we always try to get on, just good principles, and not telling you specifically what investment to buy, but just good, investment principles when it comes to managing your money that we follow is you don't have to pick a bottom. We made some changes to our stock portfolios this week, and some we were selling. They weren't the two changes we made weren't selling at the very top of what they had achieved, but still, I mean, great double-digit returns on the things that we sold.
One was triple-digit.
And the two things that we replaced, the two stocks that we replaced in our growth and our income and growth portfolios weren't exactly at the bottom. Although one of them was SanDisk, and it's rallying up even though the market is down.
Yeah.
Now,
you want the meat of it, but more so you need to figure out it's risk management. Really, is people will get into it because of stock or cryptocurrency, whatever, because of, hey, I saw it or I missed it. I missed the write up last time. It got beat up right now. I want to jump into it, but you have to have a target for yourself. When are you willing to take some profits off the table or sell it? Right? What's your target? You bought something for $100 and then it goes to $200. Is that enough? Does that meet your goals? And then on the flip side, what's your risk management? Hey, I bought it for $100. If things don't work out in my favor or doesn't pan out the way I think it's going to pan out, and it starts going down, where do I take my losses? Right? You don't want, a lot of times people will get, in a situation or a scenario where you're catching a falling knife and it goes down and down. And you're like, I'm just going to hold on to it. Sometimes people will just continue to add and add and add. It could work for some stocks and some strategies to continue to add and dollar cost average in, but you have to really do your research and know that it's, something that's not fundamentally going on specifically with a company, and maybe it's some outside event that is overreacting. But you need to have a risk management in place, right? And you need to have kind of your target on the top end, and you have to have your risk line on the bottom end to know when, hey, this is enough, this is going below or beyond my risk tolerance and threshold, and I'm out and I'm looking for other opportunities out there. It doesn't make any sense to get married to one stock, to think that that's going to be the home run. There's thousands of companies out there to invest in. There's hundreds of different types of investments out there to invest in.
Well, if you see, and I'm thinking of, a couple of days last week where the market was substantially down, there were still companies that were up. And especially some of the Dow Jones companies, some of the more consumer staple type companies, or things that people need to have, in our own portfolio for clients. You saw Gilead, was up, and then other companies like Johnson & Johnson were up.
Well, you bring up a good
aerospace. There's all kinds of sectors within each,
and you're bringing up a good point. And what's happening
class.
What's happening and what we're seeing is there's a broadening of the market. And we were talked about this in previous episodes.
You
that
mean
the last
NVIDIA, Amazon, Google, Netflix, Tesla, and Facebook and Apple aren't going to be, the way and just the holy grail of making money this year? What? Right. There's more companies out there.
They did it for 3 years in a row. So now it's time to pass on the torch, and we're seeing a broadening, which is great. So, the Mag 7 of the S&P 500, it's the other 493. So what we've been seeing is, sectors, specifically sectors like you're talking about, communication services, staples, energy, industrials, materials.
Okay.
So those are all.
To cut you off. Go ahead. What'd you say in there? What sector?
Communication services?
No, not that one.
Staples.
No, you're avoiding.
Industrials. Materials.
Nope.
Energy.
I've loved the energy sector and have talked about it for years on this radio show because, again, the world has to have it. There isn't anything we do that you can't do it without energy, obviously, in its different forms. Whether it's your utilities at your house or your business, or whether it's now powering data centers, or being able to get from point A to point B in whatever transportation mode, on and on and on. It just goes up and down, obviously, with the markets, but never, if you're in the right type of companies, the right type of gas company, the right type of oil company, the right type of, different energy product, whether it's natural gas
or companies,
coal or nuclear,
supply equipment to energy companies as well. Right?
Exactly right. There is always good investments to be had in the energy sector. Now, that doesn't mean take your portfolio, put it all in energy, because it is volatile.
Yeah.
But one of my favorite investments, it was volatile, but boy, if you just look at from when I first mentioned it, probably 5 years ago now on the radio, to where it is now, it was in the low teens and now it's in the high 20s.
Right. They even sent you a t-shirt for that, right?
As they should. You made me a t-shirt as a joke. But I still like this investment. Now, the dividend isn't as great because
it's gone up.
Because the price has literally doubled. But
yes, if you're
buying it here, it's not as good. But
right.
we'll talk more about strategies and particular investments and our thoughts on the economy, so on and so forth, and hopefully give you some tips on what you should be doing when we come back. You're listening to John Scambray and Giuseppe Viscani. We'll be right back. Welcome back to the Wise Money Guys radio show. I'm your co-host, John Scambray. I'm here with my partner, Giuseppe Viscani. And you started to mention the broadening of the market. And again, when tech has favored the market, people, that's all they want to talk about, right? That's all, even our own clients, they come in and go, hey, should we add to this? And we say, no, we're sticking to your plan. We're sticking to your portfolio, because there will be times just like this when you get bit if you chase, a price of particular companies. And now we're seeing really the broadening into smaller companies.
Yep.
International. What are some of the companies, and how is the breadth actually?
It's
here?
Just some of the, the sectors that I've already mentioned: communication services, staples, energy, industrials, materials. But then also, there's been a shift to global equities as well. So we're seeing a broadening out to, international and global companies, not just U.S. Along with other sectors, and then small caps. So smaller companies have had a boost. Currently has been going through some volatility with a market pullback, right? They're not immune to that. But you've been seeing these smaller companies, and more so the value, small cap value companies that have been coming up as well. So you have a lot more choices out there than just focusing on the Mag 7 that's been dragging the market up overall. And we'll see if this continues on. I think overall that's better for the market and the economy, because it creates a more fundamentally sound bull market, rather than a handful, 7, 10, 15 stocks that are really, a third or more of what the market is representative of. So I think, and how long are the Mag 7 going to carry it? I mean, they've already had a run for 3 years. And I think there's some realization coming into play of how much investment has gone into AI. I mean, recently Google came out.
And no profits. It's all expenses. So
yeah. And Google came out and then just, upped their CapEx spending as far as what they're putting into AI. So that's why you saw Google, this week take a little bit of a hit with this volatility. It's, when is it going to actually turn into profit, and is it soon enough? And then also, are they getting ahead of themselves where it can't be supported with all these data centers and energy and infrastructure and what have you, because it's going to take time to build out. So are all these different
flat out going to take nuclear to power these data centers? I mean, there's
you can't do
not enough refining of oil. There's not enough infrastructure in place to really keep up with the demand for the power that these data centers will take. It's really just nuclear that can keep up with that demand currently. Right. And what a joke. It's definitely not solar or wind that will, solve any sort of energy shortfall because of data centers.
Right.
So,
right. Part of the volatility you're seeing too is just the sentiment has been very bullish. I mean, there's a lot more optimistic and positive traders on the market out there, and usually it's a contrarian indicator saying that there's too many. And so once that starts calming down, then we're getting closer and closer to this volatility and this pullback to start ending, where it can flip around and start making its way back up. And so that's where you look to, hey, if I've been heavy in some of the technology sector because those were the previous winners, whether you've been in it or maybe you were late to the game and said, I need to get into it. Or maybe you're seeing the pullback now and saying like, well, maybe tech is going to, have a year like it did in 2024 and I want to ride that train again. This is a good time and we've talked about it before, to rebalance, look at what's inside of your portfolio. If you don't know, that's a good opportunity to call guys like us.
And what's the number?
867 916-967-3500. But that's exactly what we do, is look at, your overall portfolio, do an analysis, see what you're in, but then more so, put a plan together if you don't have a plan, and then make sure that those two things match up.
I started talking last week, and actually I talk about this a lot. Some of the mistakes that people make when they're managing their own money, sadly, some of the mistakes that a lot of advisors make when managing people's money. And nobody's perfect. There isn't a perfect system. There isn't a perfect, advisory process, but you try to get and try to establish and stick to principles and strategies that work, that align with people's plans, as you said. And the reality is, right here, the mistakes that people make, this is super important, is they try to time the market. So, for whatever investments they have, they try to get out at the very tippy top, and then they're always holding on, looking for more. That greed kicks in, or worse, once things go down, if they have gotten out and have locked in profits, they don't get back in. And so who did we have just recently? I can't remember if it was a prospective client or a current client, but they literally have been keeping, hundreds of thousands of dollars in cash on the sideline. And they just missed it because they thought they could time a perfect bottom. You don't have to sell at the perfect top. You don't have to buy at the perfect bottom to make a lot of money in investments over, any sort of normal period of time. And people just get, overly greedy
or overly paralysis by analysis,
fearful. And the reality is, the mistakes that you're going to make right here are, you probably already made them. Not rebalancing, not locking in some profit, and then not buying, great quality names right here. Because guess what? There's nothing wrong with our economy. This sell-off is a normal sort of market pullback. Mm-hmm. And it always happens based on some sort of news. So the news we've been talking about is there was going to be another government shutdown this year. There would be, political battles over the budget. Check happening.
Federal Reserve meeting.
the FOMC and their, mandate and how they approach, interest rates as a result of inflation data. We've been talking about these things. We've been telling people they're coming and to properly diversify. And so we were texting each other early this morning, shortly after the market opened, that, hey, good thing our clients have fixed income, alternatives, cash, real estate exposure, metal exposure, so on and so forth, and not just stocks. You don't need just stocks in your portfolio to make great returns on your money. So please don't make more mistakes. Give us a call at 916-967-3500. And let me mention again, we show people some of the things we actually have in our clients' portfolios. We talk about the markets and where we believe they're going and how, a proper approach could help you not lose hundreds of thousands or potentially make you hundreds of thousands over whatever your time horizon is. And you can see that live on March 4th from 5:30 to 7 at Wood Creek Golf Club. That's a Wednesday.
In Roseville.
And if you're way away from retirement or you're not currently retired and you don't have an investment portfolio of any kind, you probably shouldn't attend. But if you do, and you're concerned about, continuing to have good years like you may have had the last 3, you definitely want to be there.
Or to have longevity within your portfolio.
Yeah,
So
to not run out of
last
money
throughout your retirement.
The other thing we'll talk about, and I'm probably sharing this with you right now, which, we get a lot, and we should be talking about it more at our seminars, is the question on, again, if you're about to retire and you haven't, or you are retired and you haven't started your Social Security, when to take it. So we can definitely talk about that. And then also the other thing that is often, a question for a lot of people is, and prior to 75 now, should you convert to a Roth? And we've run dozens and dozens and dozens of calculations, break-even analysis on Social Security, because that's in our plan, Roth conversion analysis, that's in our plans that answer those questions. And when you work with us, if you come to that seminar, if you sit down for a no obligation consultation, you become a client, that's included in your financial plan, which is included in your advisory fee. We don't charge separate for planning. We only charge one fee for fiduciary responsibilities to you. And I think we're probably, my opinion, and I try to be humble
opinion.
I think we're the best in the area. I really do, for the value that we
best
provide.
Dressed.
Matching shirts today. I mean, come on. But at the end of the day, give us a call. You won't regret registering for that seminar and coming in and sitting down with us for a no obligation consultation. Again, the seminar is on March 4th. We feed you. Dinner is included. You should be about to retire or are retired. And the number is 916-967-3500. Okay, we're going to go to a break. You're listening to John Scammer and Giuseppe Viscani, the Wise Money Guys. We'll be right back. Welcome back to the Wise Money Guys radio show. And, we were talking about broadening of the markets, that we're seeing, investment dollars flow out of the tech names that have been so profitable as far as trades over the last several years. But really don't forget that there's, and I think I mentioned it briefly, there's alternatives. There's the fixed income space. There's the real estate space. And we can add and we think, again, if you have a basic goal, and nothing, unusual although we do have some people that have some unusual, wealth tied to things not in one of the 5 categories that are very liquid: stocks, bonds, real estate, alternatives, and cash investments. We have a client that has a 7-figure stamp collection, which blows me away. But there's people that have
silver,
gold,
guy
who's been collecting silver for decades.
Yep. Which has had a great run, but has been volatile, along with the gold recently.
Yeah. Been volatile. Gold and silver have been volatile, but now I think it's, me personally, I think it's a buy.
But they're always volatile. And we mentioned before,
as volatile as stocks.
More actually.
Yeah.
More.
Yeah.
It's got a misconception, sold as safe, and like put your money in gold and create safety, because who knows about the uncertainties of the market.
And I would say that's a lot smarter than thinking that you're safer because you're putting your money in Bitcoin. Right?
No, but the reality is, when you're looking at a long-term perspective, I think I ran it for like 20 years. The volatility of gold has been more so than stocks. So
yeah,
you put your portfolio in a stock portfolio or S&P 500 over 20 years versus gold, and you're better off with a stock portfolio.
Well, and who knows? I mean, again, I started talking about gold, primarily saying it would go to $5,000 an ounce. It did. I think over the next decade, it'll be $10,000 an ounce. I mean, again, countries are trying to, shore up their currencies, make their currencies more stable. And lo and behold, how do you do that? You tie it to a fixed, shiny metal called gold. Now, that doesn't mean you put all of your money in gold or silver, but I think if you don't have gold or silver exposure, which again, we can help you with, you should have a percentage.
We're not talking about actual hard gold or silver
exposure.
Yeah.
We can tie investments that are tied to gold or silver, just like we can, get investments that are tied to real estate and other alternatives into your account that we manage. And so I think this is a good time, if you haven't had a gold or silver exposure in your portfolio. Did you want to buy it when gold was at, $5,400 an ounce and now it's at $4,800 an ounce? Or did you want to buy silver at almost $130 an ounce and now it's at, $70 an ounce? It's
crazy.
So buy
in a matter of weeks,
buy on these dips. And if you follow our rule of thumb, where you don't buy more than a 5% position, let other things run the course before you rebalance, from there, you'll be okay.
Yeah. And it has to make sense. Like we're mentioning, different sectors of the market, or gold or silver.
Gold and silver are not good.
Yeah. So take some of this with a grain of salt. We're just talking in generality, but reality is, we don't know who you are, what your timeline is, what your risk tolerance is, if gold and silver, how much of it makes sense in your portfolio. And that's why we say, the opportunity is to give us a call, to have a no obligation consultation, to come see us in person at the March 4th, dinner workshop that we're going to have, because then it gives an opportunity to really uncover and look more specifically at the different asset classes, right? There's gold and silver, which is the metals. There's other alternative investments. There's different stocks, sectors of stocks. How much exposure do you have to different asset classes?
We still like bonds. Don't forget.
Yep. Bonds. How should it be constructed based off of your plan? That's an individual thing. And that's what we work with our clients individually, or the families, at a time. We don't just put together this portfolio and everybody gets the same portfolio, because everybody's different.
Yep.
So just keep that in mind.
But that's a crucial point, Giuseppe, because what we do is custom for our clients.
Right.
We don't just put you in a cookie cutter, basket of mutual funds, because we find that is the worst diversification potentially out there, when people just have different brands of funds with different names as far as what that fund is named and then think they're diversified. We find over and over again. Oh, and my favorite is that, they're doing it for no cost. Mutual funds, ETFs, especially if they're actively managed mutual funds and ETFs, will often have a fee embedded in them that could be as much or more than what our fee is, and you don't have a custom portfolio, and you probably aren't diversified. And so if you're thinking you're saving money by diversifying amongst different mutual fund or ETF brands, you probably have expenses in there that you're not aware of. And again, as Giuseppe said, come in, let us look at these things and just give you a second opinion and show you what you may not know is going on. And that's what I really like about our value proposition is because we take a planning approach, because then that planning approach leads to a custom portfolio where we do focus on diversification amongst the different asset classes to get you to whatever your minimum returns to objective are in the least risky way that we can get you there. Now, that doesn't mean there's no risk.
Right.
It just means that, heck, if you need a 6, 7, 8% return, that's going to dictate what your portfolio looks like. If you need a 10, 11, 12, 13% return, that's an entirely different portfolio. And one that's going to have more risk than the one that is only designed to make a 6, 7, 8%, net return. So
sometimes we'll come across clients or prospects that all they need is
even
6-7% return or less, 5%, but then they're looking for, and they're like, well, my goal is I need to make like at least 10 or 12% a year. Why? I mean, there are years, that, I've been, having some client conversations and doing reviews and saying, let's take a look at last year. How did your overall portfolio perform? How's it line up with the overall plan? Has there been any changes? What's going on for this year and in your near-term major things that are coming up in your life, like purchases, things to pay off, or big changes in goals? But last year was a great year, and they've outperformed the average return that we're trying to achieve. Great. We didn't take any more risk in order to achieve that greater return than what they need to achieve. And we'll take that because there are going to be some years that might be a little bit off. But what you don't want to do is turn the dial up and then increase the risk for the sake of just going after a higher return because you're seeing, oh, the stock market hit an all-time high. Oh, NVIDIA hit this. Oh, this stock, Palantir, super microcomputer or whatever. Silver hits, triple digits or whatever the case, and you just want to go and try and hit a home run. Yeah. But interesting fact, fun fact.
A fun fact.
Yeah.
A Time fact?
Time magazine.
Fun fact.
Fun.
F-U-N.
What'd you say?
Fund or fun.
Time magazine. So the time curse hits the Mag 7 because Time magazine came out, and the whole thing about that
it's over.
Is Time magazine.
Time magazine says it's over. It's over.
No, it's contrarian usually.
All right.
It's contrarian.
Oh yeah, because they're always wrong. That's what my sarcasm was.
Yeah, usually the cover of the magazine, they'll have something, and if it's dealing with like the economy or some sort of sector in the stock market, usually the opposite happens. And they had a cover. It said AI race now, Game of Thrones, Mag 7 competing hard. And so, and now that's what we're seeing. We're seeing, obviously there's been competition. I think there's a new one that kind of upended, some companies, Anthropic. Did you hear about that one?
Yes. And
more so on the,
mention that because I'll mention something else about it.
More of the legal. It's kind of turning the legal sector or job market. It's kind of turning that around, whereas all the AI stuff's been really hitting the software engineers and programmers and what have you. What were you going to say about Anthropic?
I was just going to it makes me think that again, talking about all this AI stuff and how that led the Microsofts and the Googles and all of them to double-digit run-ups. The thing is, and the conversation around is robots and artificial intelligence going to replace humans? And the reality is it will never replace humans.
Right.
Because
doesn't have emotion.
It doesn't have emotion. It doesn't have a conscience. That doesn't have a soul. And so people need, empathy. People need somebody who cares about their financial lives, who cares about their personal lives, depending on what your role is to families that you serve. And the reality is that computers will never have instinct, right? It's just on and off switches.
1 + 1 = 2.
They're zeros and ones. That's all a computer does. Now, it may get to the point, and I believe supercomputers or quantum computing has surpassed the electrical chemical reactions that happen in the human brain by now being able to do those on and off calculations in the trillions of transactions per second. But the reality is artificial intelligence, robots, computers will never replace humanity. So if you're thinking the end all be all is just that, oh, great, this is going to replace everything, my grandkids will be out of jobs, so on and so forth. No, it will increase productivity. It'll make us more efficient, but it will never replace us and being able to have that human connection.
Well, we should continue this conversation when we come back to see kind of.
Oh, you like this one?
Well, yeah, it's huge. It's a big topic. I mean, I just had this yesterday with a review, probably 10 minutes. We were talking about this on pros and cons and what we think how it's going to unfold. But yeah, I'll hear your ideas and then we can chat back and forth and figure it out.
Stay tuned. You're listening to John Scammer and Giuseppe Viscani. We'll be right back. Welcome back to the Wise Money Guys radio show. And you mentioned that I would.
You are John Scambray, and I'm Giuseppe
Visconti. But let's mention our number and the seminar one more time before we get back on our diatribe. But the seminar for people who are retired or about to retire, that are concerned about their investments. Well, even if you're not concerned, you just want to see why our mousetrap is better. And we believe it is. We believe it'll be time well spent. It's on March 4th from 5:30 to 7 at Wood Creek Golf Club. Call 916-967-3500. So I was saying how, AI, computers, robotics, all of that will increase productivity, but will never replace the human condition, the human soul, the human instinct, the human empathy, so on and so forth.
Right.
So
I agree. I guess the concern is what aspect of the human is it going to replace and how much of it is it going to replace, right? Like I was mentioning before, you're seeing, I have a chat with some of my cousins and they're anywhere from other financial advisors to in the financial technology industry within Silicon Valley,
investment banking.
Mm-hmm. And they were actually just chatting about it this morning. And one of my cousins says that, one of his friends that works at Meta, he's seeing a lot of just like the lower level program software engineers. They're just getting let go, right? Because AI is replacing them.
Right.
So it'll be interesting, and it's hard to come up with an answer of, okay, well then what replaces it, or what do those people now do and look for a career, right? And so that's the scary part. But what we can do is look back in history and look back at all technological advancements, right? Major technological advancements in time, and how society and life existed in jobs that were existing back then, like an elevator.
Right.
There used to be a guy that you'd have to go in the elevator, and there was an elevator operator.
Well, don't forget, there was lamp lighters, right? People would go around and light the fires and all of the gas lamps.
Right. So all of those things, and then they went away. Now that's pretty simple, right? But then it just continues to move on. We had
the closest thing is the internet, Giuseppe.
Yeah, right? We had the internet.
Internet made commerce definitely a lot different than, right? We only had going somewhere physically to buy something physical.
Right.
And the internet, created a whole new world of jobs.
And restaurants, right? Because now you can DoorDash. Versus if you wanted to go out to eat, you literally went out to eat.
Right.
Right. And now you're like, hey, I feel like such and such food. And I said, well, we can just eat at home and DoorDash it. Right. And you have to, I think the big key is that you have to find a way to adapt to it, because if you don't, then you get left behind. Right. So the brick and mortar store, like you just brought up on e-commerce, if they're just continuing to rely on walk-in customer traffic to buy their goods and products off the shelves, and now you have the Amazons and all these other stores that are adapting to shipping, and same day or next day delivery on their goods, or curbside pickup and what have you, and you don't do that and you're not adapting to it, then you're going to get left behind. So I think part of it is, how can you best adapt to this change? But it'll be interesting to see, is how many industries and sectors out there where AI or robotics, or the combination of both, can replace the human. And it either is the opportunity for that human to now adapt and tweak, but still stay in the same industry, or completely wipe out. Like my father had a tile and marble business, right? A trade.
Yeah.
Hard to think about that a robot's going to go ahead and replace somebody who can do, tile or marble or granite or whatever.
That's going to be that.
But I saw
it's going to be a way off.
But I saw, well, you would think, but I saw literally a couple months ago on some Instagram or whatever, that there's a machine that literally goes row by row, puts the thin set, and then behind it lays a tile exactly, and has lasers that just calculates everything, and it tiles a whole entire floor, right? So maybe it's okay, it'll do a simple pattern, and now the tile setter and the contractor is going to be left up to more custom, boutique type jobs, but then maybe they catch up to that. So do they still tweak it? And now do you just have an operator of that machine? Yeah, it'll be interesting to see how certain jobs, certain trades that get replaced, and how do you adapt to that?
Yeah, I think there is a definitely a considerable change to the real simple, non-highly skilled labor type jobs, especially, agriculture, maybe tiling, things of that nature. And then coming, but maybe not immediately, but some of the routine procedures that we have, I think,
surgery.
Yeah. I think all of that will be, robotic assisted,
right?
At least.
Well, we already have robotic assisted.
Right. I
wonder, at some point it'll probably just be fully robotic. You just kind of program, and you stand in the background and see it be done.
Yeah.
Really. Right. So it'll be interesting to see how that is. And then, what do kids like my kids, right? My two daughters are 11 and 12, or I'm sorry, they'll be 11 and 13 here pretty soon. What do they study? What do they get into? Right. Because some of the things that maybe I thought, or you thought when you're growing up in different trades, different areas of, where you should study and get your degree in to apply to some sort of job or career. What do they do now? So
I have the slightest idea.
I know.
I mean, in the next, the babies being born right now. Yeah. I don't think there'll be a similar job, 25 years from now.
Well, then what does school look like too? Even for my daughters, right? Yeah. So they're going to go to college here in the next, my older daughter in like 5 years,
well,
6 years.
You go to school actually, because they're just going to implant things into your brain, and you'll be perfect at everything.
Well, and that's the other kind of concern with AI is
between organic and inorganic.
Right.
Yeah.
No, well, just AI itself is how that's regulated in a manner for school where kids are not just getting lazy and doing their studies or papers or something, and then just using AI to do all the you know what I mean?
Yeah.
Right. Because AI is still not perfect, and AI is only as good as the information that it gets its source from, which is the internet.
Right.
But then where does the information from the internet come from? Right. I was actually having this debate with my uncle this last weekend. We were talking about, what were we talking about? Some sort of drug or pharmaceutical or something. And he's like, oh, well, yeah, I've done the research. Oh, no, eggs, organic pasture raised eggs, and then the regular conventional bleached white eggs, right?
Okay.
when you crack the eggs, what do you immediately notice when you have an organic pasture raised egg and you get like the conventional bleached white egg? You crack it open, put it in the pan. What do you notice?
I think one's smaller than the other typically.
Well, you get dark orange yolk, right?
Okay.
Versus it's like pale.
Okay.
It's like pale. And so my uncle and then my cousin was talking about it.
The nutrients are better possibly in the organic.
Yeah. So yolk. Well, one of my cousins, he has,
by the way, this is not a nutrition show.
But my cousin has some chickens. So I was like, how is it? Cause he's starting to get eggs. And I was like, how do they taste? And so he's like, oh yeah. And I noticed it's much darker, blah, blah. And then, his dad comes in and starts talking. He's like, yeah, I did some research on it and it's negligible. I'm like, well, why does it look different then? That doesn't make sense. You should be more nutrient dense. And he goes, well, I was like, well, where did you research it from? He's like, oh, I used AI.
Yeah. But right now, I get that AI can scour information in a blink of an eye. So
here's my quick point.
That information it's scouring was still put out there by human study,
or
human means.
Or it could be like maybe the FDA or some big agricultural conglomerates put the information. There's so much in like 80% of the information is more on the conventional egg side versus the organic.
Yeah. Reality is,
so it could be skewed.
Again, AI replacing humanity is not happening in the short term.
No.
In the next 25 to 50 years, 100 years, I hope the planet is still here. And I'm not talking about, man-made global warming and all those things. I'm talking more about Armageddon, war, famine, things of that nature. But again, the good news is that how we do things and what humans do for people, at least for the next couple of decades, are here to stay. And we hope you give us a call for that no obligation consultation or come to our seminar on March 4th.
And see us in the human form.
Yeah, see us in human form live. You've been listening to John Scambray and Giuseppe Viscani. Have a wonderful Saturday and come back and listen to us next weekend. Bye.
Have a great weekend.